This is a long-term process of wealth building. It's not a get-rich-quick scheme. It's a long-term strategy where we're just going to keep adding more and more funds into our own banking system where we have control of that. And we want to make sure we expand where you can support it. How do we grow that system in a safe manner? How have I built multiple policies over time? How do I use this?
Each new policy is a reflection of growth, not a burden to grow into. Hey, what's up, everyone? Welcome to another Wealth Webinar Wednesday. My name's Stephen Nagy. I'll be co-hosting the show today along with Mr. Craig Yenny, and we have an awesome show in store for everyone today. You can see I have my infamous whiteboard broken out of the background here. So I'll be drawing some fun pictures and highlighting some various issues on the board here today. We're gonna have some fun. If you're new here, we welcome you. We encourage you to interact, get in the chat box, talk with us, ask your questions, put the Q&A in the Q&A section because the chat box starts to go fast. For those of you that are here each and every single Wednesday, welcome back. Thank you for being here. You guys are why we do this show and continue to do so every single week. Now going on for 5 years. I don't think we've ever missed a Wednesday. So it's a lot of fun and I appreciate all of you being here. So today we're going to get into the infinite banking concept, just like my hat says, becoming your own bank or becoming your own banker, and how that can work for each and every single one of you. But more importantly, we're going to focus today on how to grow your banking system. When is the right time to start another policy, aka branch of your banking system, and what that looks like over time, when the right time is to do so, some differences in like laddering versus leveraging up on policies, and really how all of this comes together. And I was reading this earlier, and I just wanted to kind of read it out loud. It said, "You're not waiting to grow into something. You're growing because you've already achieved something. Each new policy is a reflection of growth, not a burden to grow into." And I love that because the entire infinite banking concept starts with one thing, and that's a mindset shift. It takes you away from the traditional way of how most people look at money and how most people save and how most people's money flows throughout their lives. And what I mean by that is for most people, they get their paycheck, whether that comes from a job, from their business, whatever source of income you have, you get your paycheck. And then immediately that money starts going out. It goes out to bills, to your home mortgage, your rent, electricity, car payments, credit card payments, electricity, utility bills, water bills, children's bills, everything that we spend our money on. And then if there's anything left over, we might be lucky enough to put a little bit of money away for savings. Well, what we teach with becoming our own banking system, instead of having that money flow that way, we change it. What we do is we get paid and we put our money into our own banking system first. Once it's in there, now that money is staying in our financial lives forever, for the rest of our lives. And then from there, now that it's in our banking system, and we'll talk about why that's important, why we want to get it in there first. But now that it's in there, now we can take that money and start paying bills, buying things, making major purchases, even financing things from our own banking system. When we look at the three wealth killers, and I've been teaching the three wealth killers for about 15 years now. And it's a presentation I've done for a long time. And a few years ago, I added a fourth wealth killer when I learned about the infinite banking concept and the power of becoming your own bank. Why? Because the fourth wealth killer is interest. When you look at the amount of interest that is bled out over the course of your lifetime, whether it's financing vehicles, whether it's buying homes, whatever the case might be, the amount of interest over time, it's mind-boggling how much interest we give to other banks. So by becoming our own bank, we can eliminate that from our lives, and not only eliminate, but we can take advantage of it, because now we can do what? We can do what we did with the banks before. We can pay ourselves all of that interest. So not only are we able to do what we've always done, but now we're able to grow wealth at the exact same time. And that's the power of the infinite banking concept. So we're going to dive into that here right now. Craig, we're going to lay that out, what that looks like. And I'll start drawing some stuff on the board. And then we got some cool slides created on how we can start growing this banking system. But again, please share your comments in the comment box. Ask your questions in the Q&A. We're doing this. These 90 minutes is for you. We want to make sure that all of you get a lot of value out of this. So Craig, what's up, man?
Yeah, thanks for the intro. And I always love to ask the question because we got about 157 people on so far. And we always have a group of new folks, and I love to see the numbers. So if you're here for the first time, welcome aboard. And would you mind just putting in the chat, here for the first time or just first time or something like that, just so we can kind of see and gauge how many folks we have. Because as we proceed forth, we want to just make sure we're hitting some of the basics as well. So we're starting to come in. Jessica and Kristen, you're here for the first time every week. You're a funny guy. We see your name all the time. So nice. And so one of the things that Stephen was sharing is what we're really talking about today is how do we grow that system in a safe manner? Because having done this for as long as we have, we've seen some cases where people stepped on the gas pedal a little too hard and got into trouble. So we just want to take some time and share how we've grown. And if you stick around to the end, and Stephen, I don't know if you saw this, I just added it this morning, but I was going to run through some of the things I personally do on how I build my system out. And so I can kind of share the different metrics that I'm using to figure out when's a good time to get started. But before we do that, Stephen's going to share a little bit about the infinite banking. What are some of the benefits? So when we talk about infinite banking, Stephen, what are some of the benefits? Why would somebody want to do this? And then let's think about once we get that under our belt, we'll start talking about how you grow it if you've already started.
Yeah, that's great. So why would you do this? Why would you want to become your own bank? Well, like I mentioned, we're going to start eliminating one of the four wealth killers, interest, from our lives. So again, most people, they earn a paycheck. Most people finance, things like vehicles and houses and most everything in life is financed through a credit card company, through a banking institution, through an auto finance company, whatever the case might be. And as soon as you finance that, you're giving up complete control. So first off, your money goes to somebody else. All that interest is going to somebody else. If you don't make the payments as agreed upon, they're going to come repossess your vehicle or foreclose on your home or destroy your credit card if you stop paying your credit card. So you're giving up control, you're giving up spending power, you're giving up your money. So we want to start recapturing that back into our lives. And so that's one reason why people start their own banks, is to stop that bleeding, to be able to finance those major purchases in our life with our own banking system and keep that within our families from now on moving forward into the future. We also, have a lot of people come to us to start policies because they want to pay off debt. And by using the infinite banking concept along with what Craig has created, that's called the debt blaster, is we take your situation, what you're doing now, and we show you a better way. It's all proven out with spreadsheets and with technology and software. So we're going to talk with you on a strategy call if you have debt. And again, just to clarify, if you have debt, and this is typically, there's a difference in good debt versus bad debt, and I'm not going to get into all that right now, and I do agree with that, but I'm talking about bad debt right now. So if you have credit card debt, if you have like student loan debt, if you have different debts that, are higher interest rates, things of that nature, debts that are not making money for you, debts that you're not leveraging, just something that you're stuck with, a liability. So for example, credit card, I think the average credit card debt in this country is like 22% interest. So you could go find an incredible investment, make 15% annual returns. But if you still have debt over here, you're paying 22% on, you're actually net losing money. So especially in hard economic times, if we do see any kind of recession or downturn in the markets, debt just absolutely kills people. And so we want to make sure we're getting rid of that debt right now. And unfortunately, in this country, debt is actually skyrocketing right now. We're hitting levels that we haven't seen since '08. Look at that. Even Zoom knows how wild it is with the fireworks going there. So we want to eliminate that debt. So we have a lot of people that come to us and say, hey, we have some debt. We've got in some trouble over the last few years, whatever the case might be. We're struggling to keep up with the minimum payments. We can analyze that situation, plug that into our software and our tools, and show you how to use the infinite banking concept to not only pay off that debt quicker, but also continue to build wealth and create a legacy at the exact same time that you're paying off that debt quicker. Okay, so if you're somebody that says, hey, I have some debt, I want to pay that debt off quicker, faster, than otherwise possible, then that's another reason why you might want to look into this. So debt, major purchases, and then growing wealth. This is the other big one. So we work with a lot of real estate investors. We work with a lot of wealthy families. We work with people that have done very well, and they're at the stage of life where they're growing wealth. They're planning for retirement. They have a lifestyle that they want to have. And so what we can do is we can create a banking system for them to protect their money. Protection becomes a huge part of this at this point. Because Craig, do we live in a sue happy society?
Absolutely. If you have it,
Yeah.
they'll take it.
I mean, it's to the point where like somebody, this was always when I was younger, but like somebody got a cup of coffee at McDonald's, spilt it on themselves, and it sued McDonald's because the coffee was too hot. Like it's just some absurd, some of the lawsuits we have. So we always want to be looking at protection, and protection of wealth is a huge thing. Well, one of the cool things about what we do with the infinite banking concept and creating these banking systems, it's built on a specially designed whole life insurance policy. And whole life insurance inherently is protected. It's a protected asset class. So when I put our money inside of here, our money also becomes protected in most cases and scenarios and states. So it gives us a lot of protection there as well. But we can put our money in here. Now, we got into this in the past week, so I'm not going to spend too much time, but just real fast, Craig, as soon as I put my money into this whole life policy, what are some things that happen? And I'll just write them out. Okay.
Yep. So you have guarantees.
Okay. So we put our money into this whole life IBC policy. I'll say system. I'll call it a system, even though it's an insurance policy. Okay. But number one, we have guarantees. So every dollar that we put into this policy, it is guaranteed to grow and compound uninterrupted for the rest of our lives until we pass away. Where else can you put your money and get a guaranteed return for the rest of your life? Do you know anywhere, Craig? I don't know many places. Now,
No,
coming from an investment advisor background, so I was a financial advisor, fully licensed in a previous lifetime these days, but in that world, it was completely against all regulations and laws and everything to ever use the word guarantee. You're not allowed to use the word guarantee. What I love about these whole life policies is we can use the word guarantee. It's a
and I
beautiful thing,
guess
right, Craig?
what we should say is guaranteed growth, because I can think of some investments where you can guarantee losses.
Yeah, that's a very good point. All
Yep.
right, so guaranteed growth. There we go. All right, I like it. Okay, number two, for life. All right, for life. Okay, what else is going on here? I just mentioned it, protection.
Yeah, and I mean protection can also your money's protected, but you're also protecting your family because there's a death benefit component of this.
Yeah, and I'll add that here, legacy, right? It creates a
Yep.
legacy, which is the death benefit portion. And we don't do these policies for the death benefit, but I can tell you, the older I get, the more my family grows, things of that nature, the more I realize that this is actually one of the most important parts about why we do what we do. And you couldn't have told me that in my 20s. You couldn't even have told me that in my 30s. Even once I had a child, it's taken time for me in life to understand these things. And I'm sure other people are like that. But this has actually become one of the most important aspects. When I start policy, my first couple policies I started were all geared around the guaranteed cash value, the growth, and how much I had accessible immediately for me to use to continue to grow. Now, when I start policies, this most recent one I'm looking at right now is more focused around this legacy and death benefit because that's become important to me. But we could talk about that when we get to adding policies and leveling up.
And
Craig, number
Stephen,
four.
one quick point that Shauna just posted, which I heard from a client this week as well, is they said, I want to buy my legacy. And what they mean by that is, through purchasing the whole life policy, they're buying a legacy to pass on to their family. So it's just an interesting way of buying your net worth. So it's another interesting way of passing on money, just like what Chris was saying in that open video. He's not doing this to make them rich so they can go on vacation, sit on yachts, and have someone feed them grapes, but he's teaching them how money works and also allowing them to have a system where they can tap into it to build more wealth, to fund business ideas or go to college.
Yeah, absolutely. Now, the one thing I also want to mention over here when it comes to the growth, all the money we put into this thing is going to grow for the rest of our lives. Let me also mention that it is tax-free growth. Is
Yeah.
that important?
I like tax-free.
I would say it's one of the most. I mean, taxes are one of the four wealth killers. So we want to start eliminating taxes from our lives by putting our money into here. All the growth within that policy is now completely tax-free as long as we abide by the rules of the policy. So number four, and this is probably the most important about all of these. So all of these, would everyone agree that this stuff's important, that this is nice to have, a nice place to be able to put our money? Number four is the most important reason why we do all of this, and it's why we use a whole life policy to build this banking system for ourselves. And that is use, or let's call it liquidity in the investment world. Okay, liquidity. And what I mean by that is when I put my money into this whole life policy and start this banking system, I have my guaranteed tax-free growth. I have my money protected. I'm creating a legacy for my family with the death benefit, all the stuff that happens when it goes in there. But here's the kicker. We can simultaneously use that money at the exact same time. Okay. So my money goes in, all of this begins. And remember, this is compounding growth. I'm just going to keep adding benefits here. This is compounding growth, which I'll give an example of in a second because it's important. The difference in simple and compounding interest. This is all compounding growth within this policy as well. So here's the power of this. All of these advantages, I can still use that money. I can still access the money, have liquidity of that money almost immediately. And when I say almost immediately, within 30 days of me putting my money into here, I can immediately use that money for other things. Up to, in most cases, we can build it for up to 90%. It's going to vary by person. Every policy is a little bit different, but typically 60 to 90% of what we put into here, depending on factors, okay? But 60 to 90% of the money we put in here, we're going to be able to immediately use. And then within, I don't know, 5, 6, 7, 10, 12 years, guess what's going to happen? We're going to be able to not only use the money we put in here, but we're actually going to be able to use more money than we've ever been able to put into here. Why? Because that guaranteed compounding tax-free growth within that policy, even while we're simultaneously using the money, it's in there growing for us. So at some point, the amount we put into this thing is going to be less than what the actual amount is we're able to use of it. It's going to outpace it. It's going to grow more than what we put into it. And now we're using money that we never even put into this thing while simultaneously doing all of this for us. Does that make sense?
Let me back up one step just to make sure I heard you right. So you're telling me I can put funds into this whole life policy and they're going to grow and compound, and I can use them and they're still going to grow and compound?
100%. Because look at the difference, Craig.
So in terms of the things that Stephen is sharing, if you have any questions, I mean, we have a lot of comments going through the chat, but if you do have specific questions, go ahead and put them in the Q&A. That way we can try to address them and get to them. But what we're really trying to do here is, for the folks that are newer, is just kind of lay out the groundwork on why does infinite banking work, and how is it being used. And I did see some things scrolling by earlier. Someone asked, what if I have, X amount of income, I have debt? And that's, that's where we need to get on a call with you and have a strategy call to understand kind of the whole cash flow. But is this process used for debts? Absolutely. And one of the things that when we get into some of the slide work that I'm going to share with you later is showing a use case where someone actually used infinite banking for debt. Once they cleared out those debts, restored the cash value in their policy, then they went into the next stage, which is wealth building. This is a long-term process of wealth building. It's not a get-rich quick scheme, but it's a long-term strategy where we're just going to keep adding more and more funds into our own banking system where we have control of that. And so a lot of people go, well, I don't want it to take 5-7 years, but that time's going to pass, and you're going to be happy if you started this process and started doing that. To Amy's point, is this something you should start when you're young? That would be the best time. The next best time is to start it now, because until Stephen figures out how to create a time machine, all we can do is start where we are, and throughout life we continue to learn and learn and learn. And so we want to take action when we hear things like this that are going to change our family. So you might be, so Amy, you might be the one that kicks this whole thing off for your family, and you can change generations, to come. So it all just depends on what you're trying to do, but the best time to start is now. I mean, we can't go back in time, but yeah, it'd be awesome if we could go back 20 years and start even more policies.
Yeah, definitely. Okay, cool. All right. We're back. Let's get into this, Craig. So
Right.
let me just lay out the differences, and this is going to get into the funding aspect of how do we start funding this. Somebody asked that question: how much do we start putting into this banking system? That kind of thing. So right now, when you get paid, you have your money. Most people take their money, they put it into their checking or savings account. From there, it immediately starts going out to bills. Where if I put, let's say I put $1,000 into this checking account, right, Craig?
Mhm.
$1,000 goes into this checking account. And then I have a bill. Let's say I need to pay something that's $1,000. What happens to that $1,000? It goes away, right? It's no
It's
longer doing
gone.
anything for us. Okay, here's the difference. If I take that $1,000 and I put it into this banking system, and then I take that money and I pay the bill or whatever it is, what happens to the $1,000 here?
Still sitting there compounding.
It's still sitting there, compounding and growing and being there for us for the rest of our lives. And so that's really the simple, basic difference. Okay. Now, a lot of people ask, okay, well, how much money do I start putting into this system? Okay. And that's where, when you have a strategy call with us, we want you to come prepared. Okay. So, what are some things on a strategy call that we would like somebody to have so we can really get full advantage, Craig? So, for example, income, right? We
Mhm.
want to talk to you about what your income is. And we're going to get into some stuff here right now. And if you aren't sure of it, or you don't really know where you are today, you feel like you make good money, but at the end of the month, all that money seems to be gone. You feel like you're living paycheck to paycheck, but maybe you shouldn't be, that kind of thing. I know, Craig, in 2 weeks, I think it is, you're going to do a whole presentation on that, right?
Yeah, in 2 more weeks, we're going to cover some of that cash flow management, and it's to your exact point. There's people that are trying to figure out, hey, where did all this money go at the end of the month? And so we're going to lay down some strategies that we use and recommend. But exactly to your point, Stephen, when we get on calls with folks with strategy calls, we want to know what is your current situation. And I've got some people that they'll come and say, I'm embarrassed or I don't want to share this with you, but think of us almost like we're doctors and we're diagnosing and gathering information so we can make things better. So if you have debts, we want to know what they are. We want to get those classified. We want to understand what they are. We want to know your cash flow, your income, your expenses.
Yeah. Income, we want to know net worth and assets. Okay. And then we'll
Mhm.
get to the expenses in a second, but
Yep.
let's start with the income and net worth. Now, why would we need to know this? Okay. Well, when we look at funding one of these policies, we're going to have a couple ranges that we can work within. Okay. It's because this is a whole life insurance policy. These are highly regulated. Okay. These policies are highly regulated by the United States government, by the IRS, by the TAG, by all these different entities out there. So when we design policies for somebody, we have certain parameters that we have to work within. One of the main ones of those parameters, and this is going to set up the laddering effect of adding policies, is what's known as MEC. Okay. So let's hit MEC real fast. So and the reason why we need to know what MEC is, because that's going to affect everything else within this policy. All right. So when we look at your income and your net worth, one of the reasons we want to look at this is we're trying to determine a maximum amount and a minimum amount of what could make sense to start this policy with. Because there is a maximum amount. It's based on your income and your net worth and your assets, as well as your age. So we need to know that information so we can let you know what your max is. Now, you might not be ready to put the maximum amount in right now. You might not be comfortable doing so. There's a million reasons why you might not, but we want to know what that is so we can show some options for all of this. There's also a minimum amount that you can put into one of these policies for that to make sense. Now, the minimum's a little bit easier. The minimum is typically 10 times your age on a monthly basis. So I'm 42 years old. So if I wanted to start a minimum funded infinite banking policy to start my banking system, I would want to put at least $420 a month into this policy, now $5,000 a year. As simple as that. Take your age, add a zero. That's your monthly amount that you'd want to start out as like a guideline minimum. Now, when we fund these policies, you can also do so monthly. So you can pay into it monthly, you can pay into it annually, all at once each year. You can pay into it quarterly, and that can change over time. So I'm laying this out because these things are very flexible as well. Okay. We have a lot of flexibility with these policies as far as the funding and the amounts go within those regulations.
Mhm.
So if we design a policy with the minimum amount going into it, that policy, follow me, that policy that amount actually becomes the maximum amount for that policy. Okay. So let's just say Steven's policy one. Let me delete this bank. So we're no longer using Wells Fargo or Chase or any of these banks. Okay. Now we're creating our own banking system. So here's whole life policy number one. All right. So I start this thing and I'm putting 5,000 a year into it. Why? Because I wanted to start for my first policy with the minimum amount that made sense for me just to start a banking system. Okay. So I decided 5,000 a year to put into it. However, follow me here. That's the minimum I chose for this policy, but that's now the maximum amount that will ever go into that policy. Because when we design this policy for you, we're going to maximize the efficiency of it. And the way we maximize the efficiency of it is to take it right to the MEC limit. Okay. So let me explain MEC real fast. MEC stands for Modified Endowment Contract. And these are tax rules. And the IRS tells us for a insurance contract, an insurance policy to remain an insurance policy and have guaranteed tax-free protected growth, it has to be an insurance policy to do so. To keep an insurance policy, you have to keep within the MEC guidelines. If you were to put, let's say I was to put $10,000 into this policy one year, it would MEC the policy, would convert it from an insurance policy to a modified endowment contract, and then I lose all those benefits. So we would never want that to happen. And that's where it's going to come into play, where we start adding whole life policy number two, whole life policy number three, etc. Because if I start this one at 5,000, that's the max I can put into it. But all of a sudden I start making more money. Maybe I understand the system better. My situation changes. Now I want to put more money into this thing because I love the benefits. I love what it's doing for me and everything else. I can't put more into the existing policy. So that's when we start opening up additional policies. And Craig, you're going to get more into that, right? You want to hit the basics.
Absolutely.
All right. So there's minimum maxes for both of us. All right. Now on the max side of this policy, let's say I come to Craig and I'm Craig. I want to put the maximum amount of money I can into this policy that I qualify for. I'm bought into the system. I love everything about becoming your own bank. I want to be all in on this thing on my first policy. All right. Well, you're going to look at my income, my net worth, my assets. You're going to say, Steven, your maximum amount you can put into this thing is, let's say, $50,000 a year. Okay. Now, if I start the policy with $50,000 a year, that's the maximum amount I can ever put into this policy. So if I want to put more in, again, that's when I start opening up additional policies. Now, what about the flip side, Craig? What if, let's say a recession occurs over the next year or so, I lose my job, I'm struggling getting by, I'm in between things, getting back on my feet, but all of a sudden 50,000 becomes a lot for me.
Yeah.
Do I have to put 50,000 in each year?
You won't. The way we design them, there's a minimum and a maximum. So we want to try to maximize it, but if hard times come, you can scale down and then catch back up later.
Yeah, absolutely. So typically speaking, the minimum amount you can put into this thing each year, once it's started, is usually anywhere from, I don't know, Craig, depends how it's designed. We design most of them anywhere from like 20 to, let's say, 40% less. I mean, give or take, So a $50,000 policy, my minimum might be 20K a year. And then again, I can always switch to monthly if I need to. I have lots of options. And then like Craig said, let's say I run into hard economic times next year. I only put 20,000 in for year two, 20,000 in for year three, 20,000 in for year four. But all of a sudden, year five, I'm back on my feet. Well, not only can I bump it back up to the 50 at that point, a lot of times I can even put more in because I can catch up from where I did the minimum amount in previous years. Now, I can't tell you that exact amount right now because it's always a changing figure, but that's what that's going to look like. All right. So there's a lot of flexibility in these things, not only how we design them up front, but also how you are able to use this thing, in following years. So does all that make sense for everybody? Anything we can clarify on that real fast before we move on?
Yeah, the only thing I had a question on is, what if I had $100,000 that I just want to get into the policy right away? Can I do that?
That's a great question. Great question. So let's say that, okay, we determine my situation, and for my whole life policy number one, I want to put in $10,000 a year. Okay. Nice round number, right? Let's say 12,000, $1,000 a month, $12,000 a year. But I'm like, hey, I'm comfortable saving, putting into my banking system 12,000 a year, but I just sold a real estate property. I have $100,000 sitting in my bank account right now at Wells Fargo or Chase Bank or wherever, sitting in that savings account right now, that $100,000 is earning me, it's in a high yield right now. So I'm earning like 3.2%, but I don't expect that to stay. If I use that $100,000 on something else, now that money's gone for my life forever. Like if I go buy a new Porsche or something like that. So I want to take advantage of that $100,000 that I just made by selling this real estate property. Well, what we can do is we can actually take that $100,000 and do what's called a one-time dump in. Okay? And what that would do is that would allow me to put $100,000 into this policy up front. Now, of that $100,000, I'm going to be able to pull back out about 90% of it, give or take, within 30 days. Okay. So now I can put my money into this whole life policy where it's going to create a legacy with a death benefit for my family. It's going to have uninterrupted compounding, tax-free growth now for the rest of my life. And it's never going to stop. That $100,000 is now going to work for me. Remember, one of the keys to building wealth is always having your money out there working for you at all times. So not only is that $100,000 is now going into here to continue to work for me, but I can immediately pull almost all of it right back out within 30 days to do what? Well, I can go buy that Porsche I want. I can go and invest in more real estate. I can grow my wealth. I can pay off other debts, whatever the case is. But now that money's in there, it's protected, growing, and compounding for me for the rest of my life. And then moving forward annually, I just put $12,000 a year in, or down to $4,000 a year if I need to lower it, So we have a lot of flexibility again on the annual amount, but it does allow us to get that much larger amount in upfront. And that is a very popular strategy for jumpstarting one of these banking policies. Thanks for asking that, Craig.
Yeah, you bet. All right. Anything else you want to cover, or you want to jump into it?
No, I said we jump into it unless there's any other questions I can.
Yeah, and as I was thinking this morning, what we're going to be covering would be mainly for folks that already have some policies and they're trying to figure out, how do I expand? When does it make sense to expand? But then it kind of hit me. I'm thinking, well, these same principles that we're going to talk about apply to you even starting your first policy. And so it's not only expanding, but it also deals a lot with just getting started. So for those of you,
it's also, Craig, let me also point out that it all starts with a vision. So I'm a huge believer in being able to picture something, be able to envision something before it happens. Everything The Secret teaches, vision boards. I'm a big believer in all that stuff. I have been for almost 20 years of my life now. And, I do believe it's a reason why I've been able to do what I've done in life. But the bottom line is you need to be able to see something to be able to do it. Like you need to have that vision, have that goal. Goal setting is very important. So, when we talk about multiple policies, even if you don't even have one yet, it's important to understand what that long-term vision looks like, how that growth occurs. So yeah, I love you brought that up, Craig, because it's so very important, even for new people on here.
Yeah. All right. Well, I'm going to share out some slides, and I've been trying to hit Q&A while you're talking. There's still a few sitting out there, but just a reminder for everybody. I know the chat is very active, which we love to see. And if you do have any specific questions, please put them in the Q&A, and we'll try to get to those throughout the presentation, or even at the end. We'll take some time and just go through some of those Q&A, because we want you to get value from this, and we want you to get your questions answered. So
yeah, absolutely. Throw those in there. We'll answer them. I mean, just while you're pulling that up, Craig, Wendy said, so you dump 100,000 and then do 1,000 a month. You can do that. You can put 100,000 in. It covers the entire first year. Then starting in the second year, you start putting 12 in, or 1,000 a month. So you have a lot of flexibility on these things when it comes to the premiums and what that looks like. And the last thing, Craig, I want to mention while you're pulling that up and it's loading, a lot of this is mindset. So I do want everyone to stop using the word premium. Understand it is the premium that goes into the whole life policy. But as we create a banking system and become our own bankers, our mindset is going to shift to where that is no longer a premium, and that becomes a deposit into our new banking system. Because if you think about it, when I get paid and I go put money at Chase Bank, that's not a premium, that's a deposit into my bank account. Well, if we're creating our own banking system, we're flowing our money through this policy, why would we not also consider that a deposit, even though technically it's a premium, right? So I just want you to start thinking about these little changes, because when you change your mindset, it will allow your mind to open up and allow you to start changing everything.
So here's what we're gonna do. So we kind of already hit bullet point number one, but I just like Stephen was just saying, we're going to kind of map out what we're talking about today. So step one was Stephen just shared with you a quick overview of why you might want to use infinite banking. How does it work? And for those of you that are new and just joining us for the first time, we also do another show called Take Back Control Tuesdays. And Sean, I don't know if you could maybe post the link to all of our live shows in the chat. But that specific webinar goes deep into the why of infinite banking. So if you're here for the first time and maybe some of this stuff doesn't make sense, that would be a great place to go, but we're glad you're here. And so really what we want to cover today is why would you want to grow your system? So you may have a policy or you may be thinking about starting a policy, but why do you want to grow a system? And then as you're starting to build the system out, Stephen and myself and all the people on our team, we have witnessed folks that go a little too aggressive at times. And I just wanted to share with you what are some of those risks of overexpansion or moving too fast, growing too fast, getting too excited about it, I guess, or too zealous. And then what I'll do from there is we're going to talk about what are some of the strategic growth principles? What are some things you should be thinking about before you move to that next step? And then we're going to go through an example. I'm going to share with you kind of how I do it specifically. I'm not going to get into all the numbers, but I'm going to show you my methodology of what I've been doing for years. It works for me. And so if you stick around, you'll see that. And then we'll just wrap up with some key takeaways. All right, so let's get moving on here. So why would you want to expand your banking system? And some of the questions I have just for the community out there, if you're here and you have debts in your personal economy, that you've got some third party debts, maybe credit cards, car loans, I'm just curious if you could put in there in the chat, debts, just so I know how many people here are maybe in those shoes, because I'm going to show you a specific use case here going on. So we get Christian, Shane. Okay, so a lot of folks do have debts where it could be credit cards, could be car loans. And so we're going to go through that and show you how that's going to work out. But why we might want to expand our banking system is that, maybe at your job, you now got a pay raise, or maybe in your real estate business, you've got more profits. And we can't stuff them into the existing policies that we have. So when Stephen was going on the whiteboard and he was talking about maybe $500 is what I'm starting with a month, at some point you're going to get more cash flow and you can't fit it into that policy. So that's one thing we might want to consider. And then we start thinking about how we capitalize our policies. Maybe we're using our loans to build our real estate portfolio, or maybe we loaned it to our business to grow the business. We could get to the point where we just don't have any more capital inside of the policy because we've got it all utilized. And so that could be another reason why we want to expand the system. And then Shauna mentioned earlier in the what would the Rockefellers book do? You can buy your net worth, you can buy your death benefit, you can buy your legacy. And so if legacy is important to you, if family is important to you, just like what Chris opened up with in his video about the trust, legacy is important to Chris. Legacy is important to everyone on our team. And so if you're in those same shoes, you can buy your legacy. You can buy some of that net worth. And maybe you're trying to get to a certain level. That's another reason why you might want to expand your system. And then I personally like to use the system to store capital for investments, store capital for emergency funds, store capital for when I have those major purchases coming up. And then the last thing I'd say is maybe just locking in some of the insurability. And here's one thing for certain. We don't know next year. I mean, we're all trying to, maybe we're trying to be healthier, but you don't know next year something could happen and you may no longer be insurable. So sometimes in the conversation, we talk about how are some methods we could lock in insurability. And so those are some reasons why we might want to expand. Stephen, anything you want to add to that?
No, very well said.
All right. Well, let's keep moving. And now we're going to go into some of the things. We're going to pull back the curtain a little bit and just talk about some of the folks we deal with or have come to our group that need help because maybe they've stepped on the gas pedal too hard, maybe they built their system too fast. And what we always want to do is we want to be balancing out those premiums, the loan balances with our cash flow and our liquidity. And so if you expand and you create too many policies too fast and maybe you get to the point where your cash flow is strained, we don't want that. We don't want to build in a stressful manner. And I'll be the first to acknowledge, even on our own team, you've got myself on one side, very conservative, very risk adverse. And then you've got others like Joe, HELOC Joe, man, he's he just keeps the foot on the skinny pedal. So he's very risk adverse, very aggressive in what he does. I'm very conservative. So there's there's people in between those. But all of these things need to be considered where, if you're carrying really high loan balances and you have loan balances, but you don't have the cash flow to kind of help pay those down, or you don't have the assets helping to pay those down, that could be a problem. So we always want to be thinking about the overexpansion risks. How's my cash flow? What do my loan balances look like in my current system? The last thing I want to have is my policies going into lapse. And who here wants any stress and regret in their life? I mean, I don't want any, but these are some things we just need to keep in mind as we build out. So if you're pushing too fast, what you're going to see is that, my annual premium's coming up, or my monthly premium every month is a burden. And if you're there and you're considering, well, should I be, creating more systems? Should I be creating more policies? Absolutely not. We want to make sure those premiums are easy to get to. And to Stephen's points, premiums are savings. Premiums are our deposits in our own banking system, and we want that to be a positive experience. We want to get as much premium in as we can, but we want it to be manageable. Now, who here has heard of the strategy of what's called laddering policies? And if you've heard of laddering, just put I. I'm just wondering if anyone's looked at that as a strategy, tried doing it. So we have some folks that have heard of it. So here's what it comes down to. And when we ladder policies, and I'm not a fan of it, some people teach it, I'm just not a fan of it. But imagine you have a policy that you funded with your premiums. Maybe you're doing like what Steven talked about, where you put $500 a month in. Let's say in 6 months or maybe even a year, you decide to take a loan from that policy to pay premiums for a second policy. That's called laddering, and people will take money from one policy to buy another policy. They'll take money from that policy to buy another policy. One, the insurance companies don't like it. I don't like it because it puts you at a lot of risk. And so if you start to do that and that's your strategy, I think you're trying to grow too fast. You're growing in a non-natural way. You're taking on a lot of risk. So it's like Shauna says, it's a house of cards. And I've seen these house of cards fall. And what's happened is people were laddering, and then they're taking money and deploying it into investments. Those investments break. And guess what? They no longer have the cash to pay any of the premiums. So the thing you want to do is kind of be managing the cash flow, managing how much liquidity you have left. You always want to have something left as a cushion in case something goes wrong. All right. So now what we're going to do is we're going to shift out of that negative stuff. We're going to get into how should I grow? How should I build my system? And so we're going to go through it, several different principles. The first one is cash flow, which we've already talked about. And the insurance companies have premium to income ratios. And Stephen was kind of talking about that when we were setting the minimum and the maximums. And in a general sense, think of the insurance companies are going to try to keep your premium to income ratio somewhere in that 20 to 25%. So let's say that you happen to make $100,000. Stephen, if I make $100,000, will the insurance company let me put $80,000 of premiums in my policy?
More than likely not.
Now, if I had a lot of assets, maybe, but what they're looking for is, can you sustain those premium deposits? Is this policy going to be something that actually is going to work in your life? Because a lot of people don't realize it here, but insurance companies lose money for the first several years of a whole life policy. So they have a vested interest in ensuring that you have a policy that's going to continue and you can continue to fund it. You have a vested interest in making sure that that policy is something you can continue and you can continue to fund it. Our team has a vested interest in that you continue. So it's really a win-win when this is set up correctly and you don't overextend yourself. But take your gross income, and this will be a rough number, but take your gross income, take 20 to 25% of that, and that's your maximum. And that's about what you can put into a policy. All right. The second principle is, how do we want to stack our policies? And I don't mean laddering, but I mean, how do we want to grow that in a logical way? So let's say I've got one policy and maybe I'm paying annual premiums and they're due in October. What we mean by staggering those premiums is if my second policy starts, maybe I want those annual premiums to be paid in July. And I know a lot of us on our team, we talk about this sometimes in internal meetings, but all my policies are annual and I have a way of dealing with that. But if I'm not prepared for those when they come up, there's some big numbers and I wouldn't be happy if all of a sudden the annual premiums are ready and need to be paid and I don't have the money. Maybe I've got it all deployed. So by staggering those, be better prepared to make an October and maybe make a July payment. So that's one thing you might want to think about is how do you break those out? And I'm just kind of reading comments. So Shauna's just constantly bringing up good points because she has an annual and then two quarterly. So she also has kind of staggered her premiums throughout the year. The other way to do this is just monthly. Just put everything on monthly and just make sure your monthly cash flow is going to work with those policy premiums. But there's a lot of cool strategies and if you ever get confused, you're like, I'm not quite sure what to do, reach out to your money mentor, reach out to our team, reach out to your implementation specialist. We are here to help you figure those things out. And we may say, you know what, based on what I'm hearing, I don't think it's a good time to start yet, but maybe in 6 months if you get this and this knocked out. All right. Strategic growth principle number 3. I found this quote the other day. I thought it was kind of fun. Everyone hears it, well, cash is king. Some people say cash is trash, but I mean, at the end of the day, I understand what cash is trash means. But if you don't have a cushion, then you could get into trouble with emergency funds, or let's say a really cool opportunity comes along and you don't have the cash, that kind of stinks. But I like this quote where it says, cash is king and cash flow is emperor. I mean, we want to see cash flow. We want to build cash flow because we can build on our systems with cash flow. But where the cash and the cash flow come is really having that liquidity because emergencies happen, cars break down, appliances break, kids hopping on trampolines break bones. And so those aren't really expenses that we're expecting. So we need to be able to have some liquidity to deal with that stuff. And then in this whole vein of maintaining liquidity, and Stephen talked about this earlier, you may have a policy that's designed for 500 a month or 1,000 a month or 15,000 a year, whatever it is. For everybody that has a policy, I want you to know what your minimums are because if a rough time comes and you can't make that 1,000, I want you to know what those minimums are. And if you don't know what that is and you're working with our team, reach out to us. If you're working with another agent, reach out to them and ask those questions. What are my minimum amounts? Now, we don't want you just doing minimum because then you just have a traditional whole life policy. It's not infinite banking. It's not going to build cash value, but it can get you over a hump. All right. All right. So here's a couple examples I wanted to throw in there. So if you have your illustrations, if you have your original illustrations or even an in-force illustration, these are two snippets from a couple illustrations from a One America policy and a Lafayette policy. Yours might be Mass Mutual, might be Guardian, might be Penn Mutual, it might be, some other company. But generally speaking, what you want to look at is your minimum is going to be inclusive of your base policy. So look in your illustration, find out what your base policy number is. In this case, this one's $2,582 a year. There's one other thing that we need to make sure we're covering, and that is in order to prevent that MEC, that modified endowment contract that Stephen was talking about earlier, we don't want our policies being taxable. So in the design, sometimes we have to put some term insurance, and there's a cost for that of $417.50 a year. So at a bare minimum, if this was your policy, you would want to be able to pay $2582.50 plus the $417.50 per year just to keep the policy healthy. Now our goal is to add another 7,000 in there. So that's kind of how this specific policy was designed. Now there's one other side thing is if you're not paying any of the 7,000 throughout the year, you'd want to add at least $120 to the 2582 plus the 417. That'll keep your policy safe. That'll keep all the riders on. It'll keep everything ready to go. So when you're ready to add that 7,000 back in, you can go. Now, if you have a Lafayette policy, this is what it looks like, where you've got your base policy of, say 3,000 plus your term rider of 334, plus your that minimum paid up additions rider that we were just talking about. So you'd need about 3453 if this was your policy. Your numbers could be completely different, but I'm just encouraging everybody, go learn what your minimums are for your specific policy, because when and if you ever needed to go to that level, you'll be prepared and ready for it. Okay. All right. So the next thing we're going to talk about is purpose-driven policies. At the beginning of our conversation, what are some of the things we talked about? You could use infinite banking for debt pay downs. You could use infinite banking for investing, having opportunities. You might want to finance a car purchase. So one of the things that I've found that's helpful in talking with others of when should we build more policies, let's give that policy a purpose. Why are you doing it? Are you doing it because you have more funds and you want to build opportunity funds? You want to capitalize your policy? That's a beautiful thing. We may not know what we're going to put that money into, but we know we want to store it up for, say, the next year, 2 years. We want to build an opportunity fund so that we can get into real estate. We can get into building a business we wanted to do. You might be, in your W-2 job, you might be putting some money in 401k and realize that that's not going to get the job done in total. So you might use a policy for retirement supplement. You might have a car purchase coming up, and you might have been a diligent saver and have, say, 50,000 saved up for your car. Well, if you spend that 50,000, it's gone forever. If you do that one thing Stephen talked about in the beginning, which is just change where your money goes first, which is into the policy, then you can finance that car. So the whole purpose of this is just to come up with a purpose-driven policy. And for those of you that have policies that are out there, you see a list here: opportunity funds, retirement, financing major purchases. Are there any other things that you're specifically doing? I'd love to hear from the community out there that have policies. I know there's different business opportunities, but just kind of curious, how are you guys using your policies? College? Yep, absolutely. All right, well, I'm going to keep on moving. And if you want to share that with the group, I think it's useful for everyone to see, Shane's recapturing car payments. James is doing private money lending, which that is such an awesome strategy. All right, so when we start to grow our system, maybe you started on yourself, but we want to think about, how do we build what we call smart underwriting? How do we start to build different, maybe insuring different people in our family? So could you put in another policy on yourself? And Stephen, how many policies can a person have? Because that's a question I hear a lot. How many policies can a person have?
It's not limited to the number of policies. It's dependent on really qualification, and then you can even look at buying other policies. So it's really there's no limit.
Yeah. So the only limit's going to be what they call your human life value. At some point, they're going to say you have too much death benefit. And if you get to that point, that's awesome. Congratulations. Go out and earn some more, generate some more cash so you can get more death benefit. But if you ever hit your total underwriting amount, your total death benefit, well, you can look at doing policies on your spouses. And what a great idea to have policies on, the two, the dad and the mom, or, just the people running the family, because if something happens to one of you, you have that protection. But it's also a great idea to start putting policies on your children, because look, at the end of the day, after the children have a social security number, after they're born, you can put policies on them. And they have so much time ahead of them where it can compound and grow and compound and grow. You can't get a lot of money into a children's policy, but they've got time on their side. They've got many, many years of compounding. So it's a beautiful thing to put policies on children. Who here is a business owner that maybe has business partners? I'm just kind of curious, who's out there, a business owner, and they have partners in their business? Okay, Darren. Yeah. Wendy's asking about children and grandchildren's policies. So Wendy, when we talk about children's policies, yes, you can put policies on children, and grandparents can also get policies on their grandchildren. And most times how this is happening is the children are going to be qualified based on what the parents have. So what does mom and dad have in terms of death benefits? So let's just say, for example, mom and dad both have $1 million of death benefit across maybe their work policies, personal policies, term insurance. So if they both have 1 million, the insurance company is going to say there's different companies with different splits, but let's just say generally speaking, if mom and dad have 1 million of death benefit, the insurance company would allow the children to have up to $500,000 of death benefit. So what we do is we'll back into that and say, okay, if I'm trying to fill, this policy up to 500,000, how much money can I put in to drive that? Doesn't mean you have to. You could build a policy with 100,000. You could build a policy with 250,000 death benefit. The only reason we're focused on the death benefit in this situation is that's what we're working in terms of what we can qualify for, and then we have to figure out how much money we can put in. So if you're a grandparent and you want to put a policy on a grandchild, we're still going to be looking at the parents. What do they have on them? And there are some exceptions where some of the insurance companies will allow the grandparents just to put a policy on children up to, I think it's about 100,000 in death benefit. So there are some ways we can get around that, the fact that the parents need to have death benefit on them. But that's how it works. Typically, the mom and dad need to have insurance. That's what drives how much the children can have, but it's a beautiful strategy. And Nelson Nash actually talks about that in How You're Building Legacy, because he said the grandparents should buy policies on the grandchildren. The parents should buy policies for themselves, and it just keeps leapfrogging. As the grandparents pass away, then there's death benefit to spread across the family, and they just keep leapfrogging. But going back to the business side, I see Brent's out there. I see, Christian, many others saying that they have business partners, they have a business. So here's what I wanted to share is, we're not going to get into all the details, but if I own a business and I have partners and we're busy operating our business, and all of a sudden something happens to my partner and they pass away. Well, the question is their family now going to step in and be my business partner? Maybe I don't want their family to be my business partner. So a buy-sell agreement is a legal agreement of how the business will be bought or sold between the two partners, say in a death, if there's a death or if there's one partner leaves. And what's really cool is a whole life policy can be used to fund a buy-sell agreement. And so the business pays for the policy. The business gets to use the cash value in the policy. And if one of the partners passes away, the business is the entity getting the death benefit to buy out the other partner's family. So all of those are really great strategies. We get so busy operating our businesses, but we don't think about sustainability. We don't think about contingency plans. What's going to happen if something happens to my partner? And so, Darren, I see your comment. This is your concern. What if your partner passes? Let's have a discussion about that, because we can help figure out how to build policies into your business to protect it, and to make sure that you don't have to do a fire sale if something happens, or you don't end up having business partners that you don't want to be in business with. And so the other two business related policies are key people. So you might have someone in your business that their main purpose, and they have all these relationships on the sales and the revenue. If something happened to them, they don't have to be an owner, but they're a key person. You have the ability to put a policy on those key people. You also have the ability to create executive bonus structures for key employees that you want to retain and reward. So those are all things that we can look at when we talk about smart underwriting. How do I grow my system? It could be spouse, could be with my children, could be with business partners. So those are all the options kind of out there. There's others, but those are the primary ones. Now, what I'm going to do is I'm going to show you a use case. This is a fictional person kind of based on, real situation. But for all of you that have been around the wealth webinars, you'll see that I use a fictitious guy named Bucky Doe. So Bucky Doe, Goldie Doe, it's the Doe family. And Stephen encouraged me. He goes like, what, we're tired of hearing about Bucky Doe. Can you come up with something different? And so, Stephen, I think you came up with this Dr. Billfold. So we have a guy named Dr. Billfold, and he has some debts. And what we want to do is talk through What would it look like for Dr. Bill to use a policy to get rid of debt? And then once that debt's all gone, what if he was able to take that policy and start investing in real estate and potentially start another policy? So this would be wise expansion, or a really good way to do it where he's being safe, he's getting rid of debts, and then he's building wealth after that. So let's take a look at that. I'm not going to go really deep into the debt, how we approach the debts, but if you have any questions on this, or if this is your situation, Sean and Steven can post our links where you can book a complimentary strategy call. We'll get on, someone from our team will get on with you. We'll talk about your debts. We'll talk about your cash flow. We'll talk about your assets. We'll figure out how to build a system that could be beneficial for you. Now, what I've done in some of my calls is we may find out that you can't do a policy yet, but guess what? After you get rid of the Amex card and maybe the Visa card, you'll have 277 plus 382. Now you've got over $500 available that we could start running through a policy and start working on these other things. So when we have our strategy call, it may be a not yet. It may be, okay, this will work for you. Let's go. But generally speaking, we would just want to see what your debts are, interest rates, payments, and kind of map that out, get your debt profile listed. And then what we'll do is we'll talk about 3 different ways of paying off your debts. Now, let me ask a question of the community. So everyone out there, how do most people pay off debts? And what I mean by that is if these were your debts and you had a payment of $277 on this Amex card, when this 15,842 is gone, what do most people do with that 277? Where does it go? Can anyone tell me? Where does that 277 go? They spend it, they go to dinner. Absolutely. And Shane, some of them might actually spend it on sinners too. I don't know. So vitamins, yeah, it's funny. But yeah, you're absolutely right. It disappears. Most people, when they pay off a debt, like, oh, okay, the Amex card's gone. I'm taking that 277. I'm going to go out to eat more often. And so these numbers that you see here, the total debt balance is 304,000, but if they paid off their debts that way one by one, they would be paying $273,000 of interest. It will take them almost 30 years to pay all that off. I don't know anybody that wants to pay their debts off this way, but most people do. And when you look at the numbers, it's nuts. It's absolutely nuts. So in our debt analysis, we're going to show you those numbers. And yes, Wendy, velocity banking, a beautiful way to do it. And you can actually use velocity banking with infinite banking. And those are 2 great strategies. So let's move on. That's option 1. Just remember $273,000 of interest over 30 years to pay off this $300,000 of debt. Now, you've probably heard of the snowball. You may have heard of avalanche. You may have heard of cash flow index. Those are all sequencing algorithms that you can use to pay your debt off. And what we mean by that is instead of taking that 277 and throwing it into more, buying more stuff or going out to dinner more often, we're going to take that 277, we're going to add it to the 382, and we're going to pay off our Visa card. Then we're going to take the 277 plus the 382 from the Amex and the Visa card, and we're going to throw it on to the next debt. We're just going to keep doing that until all the debts are gone, right? So we're going to do that, and it's going to be more efficient because we're snowballing or avalanching those debts. And all avalanche is, we're ordering those debts by highest interest rate to lowest interest rate. Snowball is looking at lowest debt balance to highest. And at the end of the day, here at the BYOB team, we don't care which one is the most efficient, but we want to know which one is the most efficient. And that's how we're going to structure your debts. All right. So in step 1, we saw that it would be $273,000 of interest just by doing this. This has nothing to do with infinite banking, but we've now reduced that interest down to 87,000, and our debt-free time is 85 months as opposed to 360. So I, for one, would rather do this if I was in this situation with Dr. Billfold. Now, what would happen if we actually use the infinite banking method with that avalanche structure? And how that works is we're going to continue making those monthly debt payments because we can't stop paying Amex. We can't stop paying Visa. We can't stop paying for our Mercedes, or they're going to come and get it, right? So what's going to happen is we're going to continue to make those payments, But through our strategy call, we're going to understand, do you have monthly savings? Do you have other things in our cash flow that we could say, let's run that into a specially designed whole life policy? Now, if we're able to do that, what we're going to leverage, we're going to leverage that cash value, and we're going to do either monthly or quarterly loans and throw that at the debt that's at the top of the list. So if the Amex card is the thing that's at the top of the list, guess what we're paying off first? The Amex card. So we're just going to keep funding those debts. We're going to keep funding our policy. We're going to take the money out of the policy and throw them at the debts. And we're just going to keep doing this until all those third-party debts are gone. Once those third-party debts are gone, what are we going to do? Well, we're going to take, we're going to take this monthly debt payment and we're just going to point it over at our policy, because we're now going to use that same debt payment and pay our policy back and recapture some of that money that was leaving us. But when you do a debt blaster report, you'll get a report similar to this. And what I've done is I've blown up this middle section over here so it's a little bit easier on the eyes. So remember option one, if we just pay those debts off one by one by one by one, almost 30 years, 273,000 of interest. If we do the avalanche, it will take us 85 months to pay the debt off and $87,000 of total interest paid. If we use the avalanche and leverage our savings that we put into the infinite banking system, all those third-party debts will be gone in 61 months. So Amex, Visa, the Mercedes, the building, all of those things are gone in 61 months. However, we moved some of that debt into the policy because we were taking loans from our policy to accelerate the debt. So for the next 20 months, we're going to take that same amount of debt payment and just put it back into our system. Now, something really cool happens after that 61 months. You are now in full control of how and when to pay your system back. We say be an honest banker. If you are paying $3,000 a month to Visa and Amex and Mercedes and all these other things, then pay the same amount to your system or more. However, if a bad month comes or if something comes up where you need to spend some of that money on an emergency, you're in full control of when and how you pay the system back. But if you stay on schedule, you will be done paying third-party debts plus your policy back in 81 months. And here's where it really gets exciting, because instead of paying 273,000 of interest or 87,000 of interest, you paid 57,000 of interest. And because we leveraged our savings, we now have over $100,000 of cash value to use in our policy. Now, I will say the little asterisk, the disclaimer on all of this, this is going to be dependent upon your debts, how you fund the policy, how much you put into the policy. So your numbers could be completely different. But guess what? The process is exactly the same. The process of infinite banking is still the same. But in terms of the whole context of what we're talking about today, what can we now do that our debts are gone and we have 121,000 of cash value? And there's one more thing. What else do we have? Who can tell me what else we have? Our debts are gone. We have this cash value, but what else do we have? We have death benefit, right? And so the other thing we have is control. Yes, those are all accurate, but what I'm fishing for is down here, it's very small, but we were paying $4,665 to debt, okay? Do we now have $4,665 of cash flow in our system? Yes, Christian. That is exactly right. What if we started another policy? This is beautiful. We now have free cash flow. This is a great discussion because debt's gone, we have cash flow, and we have money we can start investing with. We're now ready to start building wealth. We're ready to start leveraging that money as opposed to letting it go to debt. So you guys are exactly right. Shane, you are signed up, but I love what you're doing. And Shane and I had a really good conversation yesterday about how he's doing his system. And it's just so cool because there's different variations of how you can implement this. But anyway, let's move on, because now if we look at those three options, we've already gone over those, so I'm going to skip that. Let's assume that Dr. Billfold started a new policy with that $4,066. But I want to show you what would it look like if Dr. Billfold used that 100,000 into an investment at 12% annual investment return. Now, you might be thinking, where in the world am I going to get 12% annual investment return in this kind of a market? And there's a strategy that a lot of us in this community do, and Christian says PMC, that stands for Private Money Club. If you're new to this community, you might want to check out, and Stephen, maybe you can even put the link in there, but Private Money Club is a platform where people looking for money and people that have money meet to do deals. And they're typically real estate deals where you might fund a fix and flip, you might fund a real estate development. And it's all backed by first lien positions. Your money's protected. So it meets a lot of the things that we talk about, where be safe, be in first position. But what if we took some of that money from Dr. Billfold and we put it into a deal at 12%? And so what I'm going to do is I'm just going to jump to year 7 to show you kind of what it looks like. So he would start this in year 7 because he paid off those debts, and he's putting about $18,000 into his premiums, his premium deposits every year. He also has about $100,000 available to use because remember, we paid off the debts, we built him some cash value. So he's going to deploy that $100,000 into an opportunity. So we're going to make a loan request from the insurance company. And really that loan request is, how much do you want? That's going to go into his bank account that we call a segregated account. We're just keeping that separate from the grocery money. So this $100,000 goes into a segregated account, and then Dr. Billfold finds an opportunity that he knows, likes, and understands. So there's some due diligence he's done. But let's assume he found an opportunity where he wants to put his $100,000 and earn 12% annualized, which is, around $12,000 a year. So what is he going to do with that $12,000? Well, there's a lot of options. He can put the full amount right back into the policy. He could say, out of that $12,000, I want to cover my loan interest and maybe reinvest the next $7,000 into the deal. So this is where you're in control of what you want to do with that money. Maybe this just becomes, supplemental retirement income. So there's all sorts of different ways this money can run. I'm just showing you one example of taking those gains, paying some of the interest, and then using the rest for reinvestment. So at year 7, he's put about $126,000 into his system. Those are premium deposits. He now has a net benefit of $133,000, which is the cash value in his policy, plus his investment, plus his gains. And he also has a death benefit. And I'll just say his legacy, if Dr. Billfold died at this point, his family gets $362,000 of tax-free money. Plus, they still have $100,000 out in this investment working. So his family now has $462,000. So that's what it would look like if Dr. Billfold passed away in year 7. What does it look like in year 10? Well, in year 10, his premiums deposits go down because of maybe the structure of the policy, and we have to work within the IRS guidelines. That all depends on how the policy was designed. But because he continued doing this for year 7, 8, 9, and 10, he now has $167,000 loan balance. He can pull out $11,278. So I'm going to stop here and just say, if I put in $4,729, but I can take out $11,278, that's a pretty good banking system, right? Who would love to put $4,729 into the policy and get $11,278 out? And everybody should say me, because I want to. And did this happen overnight? No, it took that compounding to get there, but now we're there. So we're just going to keep running this through the cycle. By year 10, he's put in $166,000. He's got a net benefit of $232,000 and a death benefit of $200 plus the $198. So, and then the last year, I'm just going to run through the quick numbers here. So in 15 years, he would have put $189,000 into the system, has $429 as a net benefit. He's got $370,000 out there deployed, kicking off $44,000 a year. This is just rinse and repeat, rinse and repeat, rinse and repeat. And it actually gets kind of boring after a while, but for me, I like boring when it comes to money. I want my money to be boring and consistent and safe. And this is a really great strategy of consistency and safe. You're earning money in this policy because what's happening here? Uninterrupted compounding interest. So we're earning money here. We're earning money over here. And yeah, I mean, it's the way the system works.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
On the flip side, we already talked about some of this, but let's say instead of what Dr. Billfold did, we have an unwise expansion, and we've talked about this, so I'm not going to go into great detail, but we've seen people that just start opening large policies one after another. Maybe within a couple years, they open large policies. They put that money into some, 60%, 70%, promise of, and Stephen and I just got an interesting email from someone. Stephen, what was the guy saying? 167% a year or something like that?
Yeah. Sometimes some of those crypto investments, they get pretty big returns until they
Yeah,
don't.
it's just one of those things for, all right, well, if you're getting 167%, great, but it's just not something I feel is is real or obtainable. So there's got to be something wrong there. But let's say that Sue opened up a bunch of policies, put it into this 167% crypto, strategy, lost the investment capital, and then she has three large policies with loans in them, and she has no cash flow. Well, guess what? Shauna mentioned it earlier. It's called a house of cards just falls down. So you start getting forced into surrendering policies. You lose momentum in your whole wealth building strategy, and now you've got debt to deal with, and you kind of took several steps backwards. So the message is, don't be like Sue. Don't be like Sue. Be like Dr. Billfold. All right. So for those of you that want to know and stick around, I'm going to share a little bit about how I do this. And it's not that this is the way everybody should do it, it's just as how I do it. And so what I do is I've got what I call a warehouse of cash. It's my own banking system. And what's made up of that banking system are a series of whole life policies. And I also have something called an all-in-one. It's a first lien mortgage. So it's an ability for me to have access to my equity. And so to me, it's just another warehouse of cash that I can use. So between the whole life policies and the all-in-one, the benefits of my banking system is that I have uninterrupted compounding interest in my whole life policies. Whether I'm using my equity or not, I still have long-term appreciation in my all-in-one. And because I have capitalized and I have equity, I have opportunity funds. So when I saw this message come through where I could get into this crypto fund for 167%, if I wanted to, I have the money to do it, but I'm not going to because I don't feel it's a safe place to put my money. I don't have anything backing it. But let's say Stephen comes to me and says, "Hey, Craig, I'm looking at this deal, this real estate deal. Would you be willing to get in with me?" And we do all of our due diligence. Well, absolutely. Let's go do it. The other thing it allows me to do is if I have a major purchase and I want to finance my own cars or finance a horse or finance whatever it's going to be, I can do that. And then I'm very conservative and risk adverse. So I like to have a big cushion of emergency funds because I know that life throws curveballs and I want to be able to, handle those when they come. That's what my warehouse of cash affords me. Now, how do I grow safely? How have I built multiple policies over time? How do I use this? So my specific strategies and yours might be a little different, but I like to maintain cash. I like to have cash for opportunity funds. I like to have cash for emergency funds. I like to have cash for financing major purchases. So part of the question for me is if I'm going to expand my system, do I feel I have adequate cash to accommodate all of these things? And if I do, then I'm going to go down to the next bullet point, which is I'm using most of my capital for investments. And so what I do is I say, what are some of those measurements I do to drive the decision to deploy more capital? The first one is I want to know how much of my capital is clear of warehouse loans. Let's just say I take $100,000 out and I put it into an investment. Well, now I have a $100,000 loan in my warehouse that I have to manage and take care of. And it's not that I have to, I'm in control of that. So I'm not going to a bank. I'm in control of that. But one of the things I want to measure, and your percentage might be completely different. I typically don't want to have I don't want to have less than say 50% of my money out being, having loans attached to it. Your number could be 10%. Your number could be 5%. It just depends on how aggressive you want to be. So I like to have a lot of capital sitting there for those emergency funds, opportunity funds, financing major purchases. So the first thing I look at is how much of my money has a loan on it that's out working. The next thing I look at is something I call capital at risk. And let's say you put 100,000 into a deal and you start, say it's at 12% and you start getting $1,000 a month. Immediately I have $100,000 at risk because if that went away, I've lost 100,000. So when I look at all of the things in my portfolio that I'm doing, I don't want the overall portfolio to exceed a certain amount of capital risk. And right now, for me, I think that's about 70%. But that can change over time. So I don't want my capital to be higher than 70% at risk. The last thing I look at is how much of my capital is at rest. How much do I have to support these first three bullet points? And over time, you might get to the point where you feel you have too much capital just sitting there. And that's one of the things. I may deploy capital even if I am already over my capital risk number. So I kind of weigh those things out over time. This is just how I do it. I'm just sharing with you because you might find part of this, you're like, hey, I like what Craig's doing. I might take that piece of it. I might do it. And you might look at this other stuff like, I don't care about the capital risk. I'm just going to be aggressive and go after it. That's fine too. That's just something you'll have to figure out. Now, I'm going to show you a quick example of what I mean by capital risk. So let's say we take 100,000 of capital deployed in a private lending deal where I'm getting interest-only payments. So let's say over time I've received $50,000 of interest. Well, at that point in time, if I take my interest divided by my capital deployed, that means I'm about 50% of my capital risk. Which means if that deal completely went away, I've at least received 50,000 of my 100 back. So that's why I'm thinking, for me, as I'm deploying, I don't want to have a lot of capital risk because if things start breaking, I'm going to, decrease my passive income or my investment income. That's just the way I'm building it out. And so your number might be different, but that's how I'm measuring it. So now I'm going to walk you through a couple kind of the way I do this, and the numbers aren't, exactly right, but your numbers might be 10,000. So instead of deploying 100,000, maybe you're deploying 10,000. Maybe you're deploying 500,000. The numbers aren't what I want you to focus on. I want you to focus on the process here. So let's say that I find a deal where I can put $100,000 to work at 12% annualized, which means every month I'm going to get $1,000, $1,000. And I'm just going to keep getting that until the deal's done. Then I'll go find another one. But one of the things I look at is if I'm starting brand new. So Dr. Billfold just got done with his debt payments. Now he's doing investment. He might be starting where he just put 100,000 to work. Well, if I have 100,000, I'm getting 12,000 a year. It's going to take me 8.3 years to get my 100,000 back. Now, this isn't considering taxes and all that other jazz, but I'm just saying if I have 100,000 and I'm getting 12,000 back a year, it's going to take me about 8.3 years to get it back. So the question for you is, when are you ready to deploy more? When are you ready to start more policies? And so you have to come up with what your own thresholds are of how much capital do you want risk? How much capital do you want clear of warehouse loans? But that's for you to decide. I have my numbers, you'll have yours. Now, what I want to show you is over time, this is what's beautiful. Let's say that at some point I got comfortable with the fact that I want to deploy another 100,000. So maybe I paid the full thing back in my warehouse. I don't know. But now I'm deploying 100,000. So now I have 200,000 at work at 12%. So now I'm getting 2,000 a month. How fast will I be able to clear this 100,000 out? Well, if I take 100,000 divided by 24, I can now clear that 100,000 out in 4.16 years. So do you see what's going on? Over time, I'm building more and more wealth. I have capital clear of my warehouse that's just creating cash flow. And if we just keep doing this, now I'm going to jump to the point where maybe I have 500,000 at work. If I have 500,000 out working, generating 5,000 a month, and I want to clear this 100,000, it's now only going to take me 1.6 years. So do you see kind of what I'm doing is I'm just simply being safe about deploying money, clearing it, deploying money, clearing it, deploying money, clearing it. But inside of that whole process, I might get to the point where, well, when I get 3,000 a month of cash flow, maybe I'll start another policy because I have the cash flow to support it. But anyway, that's just kind of what I've been doing. And if anyone has questions on that, I'm happy to share. But it's kind of how I've mapped it out over the years, and it's been working. Has this little money guy ever dropped the string and the wagon went down the hill? Yeah, I've actually lost some money in deals, and did it suck? Yes, it sucked, but at the same time, it didn't break my system because I've been carefully doing it. And so I don't want to lose any of that, but if any of it ever goes away, well, I'm doing it in a safe way where I can recover from it. I just feel if I was completely deployed out of my warehouse and things break, well, that's gone, and I have loans to pay back and no cash flow. So that's why I do it the way I do it. Key takeaways, and we'll wrap it up and get some Q&A, but from my perspective, and Stephen, you can add to this as well, but I think when you're growing your system, you want to think about it strategically, not emotionally. Sometimes you'll hear people out there talking about, well, I've got 25 policies. That's awesome. You've built a system over time, but it doesn't mean you need to get to 25 policies. Maybe the number for you is 3, maybe it's 5, maybe, don't get tied up in the emotional competitiveness of, well, because so and so has 20 policies, I need to get that tomorrow. We want to prioritize cash flow and liquidity. Always make decisions on the cash flow and liquidity. Do you have liquidity for the opportunities? Do you have liquidity for emergency funds? Do you have cash flow to support new policies? And we want to make sure we expand where you can support it. And the last thing I'll say on this is that infinite banking, we talk about it as a marathon. It's a marathon. It's a long-term strategy. Patience wins. And guess what? The time's going to pass anyway. So you might as well do it because, when you blink, and I was always told as you get older, time seems to accelerate, and it does. And so I'm glad that I've been doing this as a long-term strategy, and I hope that all of you are. And if you're just hearing this for the first time, it's worth putting some time into figuring this thing out. And there's a team of us here to help you on it. So with all of that said, let's go to some Q&A, and I'm happy to go back and touch on anything here, but let's open up to some Q&A, Stephen.
Yeah, definitely. I mean, I've answered all the stuff in the Q&A box, unless somebody has something they want to clarify, or maybe my response typed out was not what they were looking for. I'm happy to, answer live here.
Yeah.
Other than that, just a lot of people saying they're excited to get started. I'll say one more time, schedule a call with us so we can answer all your questions and look at your situation, talk to you about your goals, what you're looking to accomplish, and create that plan. So I put the link over in the chat box for that. But hit me. What else you guys got here? Let me see. PMC is privatemoneyclub.com. Privatemoneyclub.com. If you'd like to schedule a call and talk to somebody about Private Money Club, I'll put that in the chat box. And then, like I said, next week is the in-person Dallas Money Tank event. So we do have a couple tickets left if you want to come in person to Dallas, but if you just can't make it, I'll put the link, and it's $197 for a virtual ticket, but use the code DMT, which stands for Dallas Money Tank, DMT 100 for $100 off. So you get a virtual ticket for $97. You can participate the entire 2 days, and we'll be sending out the recordings as well. Let's see.
Yeah.
Yeah, everybody loved that today, though, Craig.
Yeah, I'm glad it's helpful. And it's just one of those things where, I'm trying to think through how, everyone on our team, we all do something a little bit different. And it's really cool because infinite banking is a process, and you can see how everybody's doing a little bit different and similar things, but maybe deploying differently or being more aggressive or less aggressive. But ultimately, we're here to help you with whatever strategy you want to use. If you want to, get into debts, paying off your debts, if you want to get into investing, if you're looking to pay off, college, whatever it is, we can kind of help you with all that.
Yep. And just throw it out there. If anybody ever needs anything within our campfire, our ecosystem, BYOB, Money School TV, Private Money Club, any of our brands or companies, reach out anytime to me, snaggy at privatemoneyclub.com. I will definitely connect you, guide you the right way. We have a lot of trusted partnerships with self-directed custodians, with attorneys to do trust, tax strategies, people we've worked with for years that have glowing reviews from all of our clients. So if anybody ever needs anything in the financial world, let me know. Again, we do 6 live webinars for free each week. We do live webinars through Money School TV each week, which is $19 a month. We do 2-hour coachings. We have coaching programs for private money and real estate investing. So we have a lot around the financial education, primarily though in the infinite banking concept and real estate investing, whether that's active or passive. So if you're doing rentals or flips or wholesaling or private money lending funds, development, anything in that world, that'll all be private money club related. So I know it's a lot. If it's your first time here, you just got to start taking little bites, take little pieces. Something I've always, kept in the back of my mind when I learned something new. And, I've always tried to tell clients and students, you start out as a baby in life. It's the same thing when it comes to education. It's the same thing when it comes to doing something new and investing. You have to, crawl before you can walk. You got to stand up before you can walk. You got to walk before you run. But, once you're off and running, you can do marathons and ultras and everything else in life. And it's no different when it comes to education, learning, investing, and all of it. So start small. We're here to help and support. If it's, one of the things that holds a lot of people back is fear. If you think about fear and what it is, it's simply just not understanding something in most cases. It's not knowing what is there. Like a lot of people are scared of the ocean. Why? Because underneath that surface of the ocean, you get into a whole different world. And, people are fearful of that because it's not normal. It's something new. Most people are scared of something new, scared of change, scared of going against what they've done their entire lives. But guess what happens when that does occur, and you do it? That fear goes away. And all of a sudden, in many of these cases, you'll never go back to the old way because there is a better way out there. And that's what we do, especially when it comes to the infinite banking concept. This has been around for 200 years. It's used by some of the most successful and wealthiest families the world has ever known. Banks themselves buy more whole life insurance than anybody else out there. And we just mimic what they do at the end of the day. So it's a beautiful thing.
Yep, absolutely. I really liked what you said about fear just being not understanding, because it really is. I mean, this is an unconventional, what I'd say, an unconventional strategy. And when you're going against the mainstream of what we're told to do, it is scary. But you have a whole group of people, and I love this community because there's so many people out there, Christian and Shane and Tess and all these people just responding to questions, sharing their own experiences because they've been around the campfire, they've done this. So, the more the merrier. I love it.
Absolutely. Absolutely. And yes, this will be on YouTube. So we record every one of these wealth webinars. We put them on the YouTube channel at the Chris Naugle, and it'll be edited and put up Saturday typically. So look for it on Saturday. But if you go over there right now, youtube.com/the Chris Naugle, just subscribe to the channel and you will be able to be alerted when new videos are posted. And you don't want to miss them. A lot of good content every week, and it's all free of charge.
Yeah, you know what else I saw on Bill Folds having dinner with Bucky Doe? Yeah, I love it, Tess. He's definitely going to. But I got a notification on my Facebook this morning that the Infinite Banking group that we have has reached 5 years old.
Wow.
Yep.
It's pretty cool.
Yep. So if you're not part of that, join that as well. We'd love to engage and have you ask questions out there. But what's coming up later today, Stephen, at 4:30 Eastern?
Yeah, so 4:30 Eastern on the YouTube channel, as well as some Facebook pages, is Ask Me Anything Happy Hour. So you can join us. Our money mentors will answer your questions for an hour straight live on video. So join us on YouTube or social media, Facebook, ask your questions, and we'll answer them all for you. Spend an hour doing that later today at 4:30 Eastern. It's a lot of fun. So with that being said, Craig, any last words?
No, I appreciate everyone's participation. We're happy to help answer questions. I know there's a lot of material we throw at you, and show up at AMA, ask questions, book a call, strategy calls. We can answer questions there as well, but we're here to help. That's why we're doing these trainings.
All right, cool. And Ryan's buzzer beater question: do you use a number of different insurance companies? We do have partnerships with, I don't know, half a dozen or more insurance carriers. Just to name a few: One America, which is American United Life, Lafayette Life Insurance Company owned by Western and Southern Group, Mass Mutual, Guardian Mutual, Penn Mutual, Security Mutual Life, just to name a few. So with that being said, appreciate everybody being here today and every week. Hope to see you guys next Wednesday, where Mr. Brian Fouts will be leading the charge, because Craig, myself, Shauna, Chris, and a bunch of other people from our team will be headed to Dallas, Texas for the money school, or for the Private Money Club Money Tank. So hope to see you guys in Texas on the virtual, and right back here next Wednesday with Brian Fouts. And then in 2 weeks, right back with Craig. And we'll be diving in on paying down debt and how to control your money going into this economic change. So thanks again, everyone. We'll see you soon.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.